Students, this is the second video in your Chapter 8 video set. So we are going to move out of talking about notes and start talking about some other types of short-term payables, meaning that they mature within 1 year or less. So the most common type, and we've done quite a bit of accounting with these, are accounts payable. This is amounts that we owe to suppliers for merchandise or services. Sometimes we call them trade accounts payable. As a reminder, an example we used a lot is where I say, okay, I've gone into Office Depot, and for some reason they let me walk out with a ream of paper, and my debit would be supplies, and we've said my credit is accounts payable. That's an example of it. Means I owe them that money within a year. The most common thing that you see in the short-term liability section for almost every company is payroll expenses. And I shouldn't say expenses because it's on the balance sheet, but payables associated with employees. So we're going to go pretty deep on this. You might want to even pull out a pay stub if you've got one so that you can follow along. So every time, let's just say I'm a company, I open up a bicycle store. When I have employees, there are employee costs that I have that might be invisible to you as the employee. So let's go through those. The employee, right? You know when you look at your paycheck that you guys are paying taxes both to the U.S. government and to the state, right? That's money that your employer takes out of your paycheck and remits to the government. Why do they do that? They do it as a courtesy and it's the law. In theory, you owe that money to the federal and the state whether they take it out of your check or not. Now, you're also paying for your Social Security and Medicare. Some people call that FICA. You might hear the terms interchangeably. Maybe you don't have this yet, but you might when you get your first full-time job. You might go ahead and pay for health, so your health insurance, dental insurance, disability, etc. A lot of times companies will help you source those requirements. So in other words, I need health insurance. I'm lucky enough that Queens helps provide health insurance, but I have to pay for part of it, and Queens pays for another part. And also, sometimes companies take money out so that they can invest it in retirement plans for you, right? So these are things that are your cost. You're the employee. Now let's think about what the employer's costs are. All right, federal and state unemployment taxes, right? So that's not the same as the federal and state taxes you're paying. That's your income tax. Employers have to pay both the federal government and the state governments extra money for each of their employees to cover the unemployment fund, right? Now, employers also have to pay the same amount that you pay into Social Security and Medicare, also known as FICA. You probably didn't know that, right? So it doesn't just cost employers money in the form of payroll when they have employees. They're paying these unemployment pieces, and they have to match the FICA and the Social Security. So it's expensive to have employees. Now, optional things that employers do, sometimes they help provide the costs of health care, dental, disability, and sometimes they also help pay for your retirement plan. But those are more optional. The first two are required by the government. Okay, so we talked about federal and state income taxes, right? As the employee, you have to pay those regardless. Now remember, if you get a paycheck, your employer is taking the money out of your check, so they're taking the money from you, and they're giving it to the government, right? Why do we do it this way? Because if we left it to everybody to pay the government directly, right, so the employer sits in between, people probably just wouldn't do it, right? And so then the government wouldn't get the money. That's why employers are required to withhold it and give it to the government. They're doing that for your federal and state income and for your FICA. All right, and we've talked about the other types of things that you may choose to pay, such as life insurance, health insurance, savings. Right, and we've talked about the employer costs. They have to pay that FICA. That's the Social Security and the Medicare. So you both are paying that. And then they're also paying those unemployment taxes. Some people call them FUTA and SUTA. Right, that's a big deal right now. You may have heard in the news, if you're watching these videos during, April of 2020, unemployment where people have filed to receive unemployment benefits have skyrocketed because we have so many businesses closed. Well, where does that money come from for those people to get those benefits? Well, it comes from the pool that employers have paid the government for those benefits. So, said differently, right? I have a business, right? I'm the employer. I'm constantly giving money to the government to set aside for unemployment, right? So now the government's got all this money. It's kind of like Medicare, right? Or Social Security. Now there are people that are unemployed and the government's giving those people money. All right, and then fringe benefits. When we talk about fringe benefits, those are just the extras that if you work for a company, they might give you. So for example, if you went and got a job at Starbucks, they would probably offer you health insurance, dental insurance, life insurance. They also might contribute to a retirement or savings plan. So you want to always watch for that as you get your first jobs out of school, because you want to understand what kind of fringe benefits you're getting, because that's real money, right? For example, at Queens, if I put money into my retirement plan, Queens will match some of it. Well, that's free money. I want that. So that's a cost to Queens, whatever they match. What I put in is only a cost to me. Okay, so let's go through an example of the journal entries. And you can think of these journal entries in sets, right? Because you've got the act of paying your employees, and you've got the act of the other additional expenses you may have just for the sheer fact you have employees. All right, so in this case, let's go ahead and record salary, expense, and withholdings where we've got payroll of $100,000 for 20 employees. Well, remember, the first one's easy, right? Salaries are what people think that, what we've negotiated to pay them. That's going to be the expense. Will it be the cash they get? Nope, right? If you get a job and it says you're going to get paid $10 an hour, do you get $10 an hour? No, you don't. You get something less because they've got to take out a bunch of money and give it to the government. So how do we figure out what else there is? Well, we've got the income tax payable, right? That's how much tax we as the employer are withholding to give to Uncle Sam on your behalf. That's just simply the employer saying, I'm going to take $24,000 out of your pay. I'm going to hand it to Uncle Sam for you. Right? Now, in this case, we've also got FICA, right? So this is the FICA that is the employee side of it. And this could be a credit to cash, but right now it's just a credit to salaries payable because we haven't paid them yet. All right, so that reflects how much money I owe my employees. But there's another set of entries I still need to do. I need to record everything up, these fringe benefits. I've told my employees that I will help pay for some of their benefits. I'll help pay $5,000 in health insurance paid by employer, and I'll contribute $10,000 to their retirement. That's a real expense. So I'm going to debit salary expense, and I'm going to credit two different accounts payables, one to Blue Cross Blue Shield, because me as the employer, I need to pay Blue Cross for your health insurance. And to Fidelity, Fidelity's a brokerage house, so let's assume they're managing the retirement plan. I'm giving $10,000 in your name to them. All right, and then lastly, as we said, these are these additional costs that you and I as employees kind of don't even realize are happening, right? We know about our salary. We know about our fringe benefits. We don't really realize that the employer's coming in and paying these as well because it's transparent to us. So this is where the employer's coming in. They have to pay they have to match all that FICA that we paid. That just goes straight to the government for the benefit really of everybody in the country. And then again, unemployment. And that's not on a per person basis, as in there's no unemployment money sitting aside just specifically for Jennifer, right? It's just an unemployment fund, right, for everyone, right? And that is an expense for the company. So I want you might need to go back through that a couple times because remember there's three sets. Set associated with the salary, where I've got to withhold money as your employer and give it to different people. I've got fringe benefits. And then I've got the costs as the employer that I've got to pay just for the sheer fact that I have employees. Okay, 3 different types. So go back through that again and then come back to this portion, pause, and try to work this on your own. Okay, so hopefully you're back. It's starting to make a little more sense to you. So we're going to do the 3 sets of entries. We're paying our employees salaries of $1 million. Okay, so let's start with the salary expense. Okay, well, I know expense is going to be $1 million, right? That's what I've told my employees their salary is. I've got to go ahead and, oops, sorry, that did not. Got salaries expense, and then I'm going to have the income tax payable, which is the federal and the state that I'm taking out of my employees' paychecks and I'm handing to the government for them with their name on it. So they're paying the government for me, so that the government's got the money associated with my salary. FICA, this is something, again, they take out of my paycheck as the employee, and the employer is giving it to the government for me. Now, I'm paying a part of my health insurance as the employee here. So that's why you see more money being taken out of my check and given to Blue Cross Blue Shield. Don't confuse that with the employer's portion, because see up here, the employer's portion, sometimes that's what they pay, right? The employer versus what I'm paying. If you can find a job where they pay for all of your health insurance, take it. But in most cases, you're going to pay some and they're going to pay some. All right, so, and then we balance it with salaries payable. Now notice the money that they're taking out of my check and giving to the government, right, in these 2, and giving to Blue Cross Blue Shield, that doesn't raise the expense. The expense is still the salary. All it does is lower how much cash they're giving the employee. So look at your check and see if you can notice what your salary is, right, versus what gets taken out for income tax, Social Security and Medicare, also called FICA, and for any other benefits you might have, such as health, dental, life, etc. All right, that's the first set of entries. Now let's do the second set. So fringe benefits, this is what they are going to pay for us. Right, so they're going to pay Blue Cross Blue Shield $30,000 for what they're willing to pay on my health insurance, and that's an expense. Right, that's the only fringe benefit they've given us in this situation. And then our last entry is around that extra money they have to pay the government that you'll never see anywhere on your check, but this is the sheer cost of having employees. Credit to FICA payable, because they have to pay the government. Credit to the unemployment tax payable, sometimes called FUTA and SUTA, and debit to expense. That goes to expense because it's real money that they have to pay in addition to what we pay for the sheer fact they have an employee. So you might say to yourself, why would anybody have an employee if they have this extra expense? Let's make everybody contractors, right? And not call them employees so we can avoid this. Well, the government keyed in on that, and what they came back and said is, you know what? If it looks and acts like an employee, it's an employee, and you can't avoid paying these extra taxes on the people working for you. So people thought they had a nice loophole on that extra employee expense for a while, but it went away. All right, so let's wrap up other current liabilities. We can have some deferred revenues. These are liability accounts, recorded cash to receive in advance of sale. I'm just reading that off the page. But what does it mean? We've dealt with deferred revenues all semester, right? Deferred revenue means you've given me cash, so me, cash, but I haven't given you the product or service yet, right? So in our donut store example, this is where people would come in and they would give us money and say, I'll come back for that donut later. And we would debit cash and we would credit deferred revenue. Right? Or maybe somebody came in and bought a gift card, right? And we would debit cash in that case. And again, we'd credit deferred revenue, right? Or gift card. Because we haven't done anything to earn that money yet. What kind of account is deferred revenue? Liability, right? We been talking about that all semester. Sales tax is another payable. This is different than employee taxes. This is the sales tax we pay when we buy products, right? I buy a product, I always have to pay a little bit more than what's on the sticker. Here in the United States, I pay that sales tax. In Europe, they do this wonderful thing where they have a VAT tax and they actually add it to the sticker so you know what you're actually going to pay when you get to the register, which is super helpful. And then lastly, you've done this all semester. Anytime we have long-term debt, so let's just say I had $10 million long-term debt, and $9 million was due in 10 years. $1 million of it was due in 1 year. I would move just that current portion to current liabilities and leave this in long term. All right, so again, this is an example that we've talked about. When Apple sells an iTunes gift card, they debit cash, they credit deferred revenue. When somebody actually uses the gift card, then they debit deferred revenue to reduce it and credit sales revenue. All right, I'm not going to go through the sales tax example. There won't be any of those on your test. Again, we've gone through long-term debt. You can read these slides, but you should understand what they are. And that's the end of video 2. We'll wrap up in video 3 with contingencies.